Welcome to the Daily Update, where I'll go over the action in the market for Friday, June 23rd, and then we'll see how things look for Monday, June 26th. We're turning more negative now. We needed a good solid up day. We ended up having a down day. On the positive side, we're working off more of this short and intermediate term overbought condition. In fact, with one of our short-term indicators, we're oversold already. We're seeing a lot of the improvement that was under the surface starting to go away. We are in a seasonally weak period of time right now, but we'll see. Once we get past this period of time, can the market find some support underneath where we're at and then be able to go back up higher? Before I get started, please note that there is a PDF in the description below the video where you can download that and follow along with the slides and charts. I do have a private Facebook group that you can join. There will be a new poll posted over the weekend, and I really watch the YouTube comments closely. In fact, when I posted yesterday's video, within about a minute or two, there were like 45 comments on there, all generated by a bot, and I quickly went in and got rid of those. I do also post on Rumble, so if you have trouble finding me on YouTube for whatever reason, you can find me at this channel on Rumble. All right, let's go back and talk about what happened. We did have a gap lower open down below S1 at 43.62. We fell below that. We didn't quite get to S2. Now, we would get there later, but earlier in the day, S2, which was at 43.42, was still below current prices. Prices then tried to rebound, and we did get above S1, but as the day went on, we fell back below S1. We went all the way down to S2 this time, but then we came a little bit off of that going into the close. We were down 0.77% on above average volume. Now, some of that is attributed to the Russell indexes rebalancing, and there's this massive amount of volume right at the end of the day to shift things around. It doesn't really change prices all that much. It just rebalances all of the indexes. The technicals are positive right now, but they're turning more negative. And a lot of this shorter term positive backdrop that we saw improving is starting to show some weakness again. And a lot of this has to do with inflation and interest rates. And this is producing growth concerns, not only in the U.S., but we're seeing a real concern more globally now. What are some comments that we can make? As I just mentioned, there are these concerns. You've seen central banks all over the world raising interest rates, and they're afraid that not only the Fed raises rates until they break something, well, this can happen in other countries as well. When the whole globe is doing this at the same time, that can really slow things down on a much bigger scale. There was a reconstitution of the Russell indexes, which produced a lot of heavy volume. And on a short-term basis, we still have some of our stochastics that are overbought. Intermediate term, we're watching our oscillators. They're kind of coming from extreme positive territories and starting to roll over. But on a short-term basis, the Stoch RSI has already gone extreme negative. The dollar was up, and they're attributing that to some of the weakness that we saw. The dollar's been bouncing around, not really moving all that much. It's trying to go back up, then it was coming back down. Well, in Friday's session, it saw a bit of a rebound, and interest rates were also falling. That has more to do with the global slowdown concerns and didn't really give that much support to stocks. We still have all of our yield curves that remain inverted. Sentiment is now dropped down to positive, where we had been extreme positive, over 75. Now we're at 74. In our trend, it's still positive. The green line's still on top, but it's coming down. The ADX is rolling over, but it's still above its moving average, and both are above 20. Our bias is now negative, and our momentum is back to mixed. We're not really full-blown negative yet, but we're certainly not as positive as we had been. Looking at the economic reports that came out, we had the IHS Market Manufacturing PMI. That's based on manufacturing, and this is what gave some concern, even though it's not a real influential report. The fact that we're under 50 is showing that there's a contraction. It came in at 46.3. Last time it was also under 50, but came in higher at 48.4. And then the services PMI, it's still above 50. It came in at 54.1. Down from the 54.9 that we saw last time. Looking at some Isabel net charts, this is put out by Carson, saying a strong start to the year could mean more gains. Doesn't really feel that way right now, but things could change. As I stated, we're kind of in that weak period of time right now, which historically has played out in the month of June, where we tend to see a stronger finish going into the end of the month. When you compare all the years with each other, we're up about 5%. And then when we have 10 to 15% returns coming up to the end of the first half of the year, we see pretty solid gains after that. And that's the scenario that we're working with right now. Then another chart that's kind of interesting is it's showing the S&P forward earnings yield and then subtracting the 10-year Treasury yield. And this is getting really low, which means that the earnings yield is underperforming and the Treasury yield could start to look more attractive to bond buyers because they're seeing on a relative basis that bonds are giving a better return than looking forward at the earnings for the S&P 500. Then we look at the exposure to oil. It really hasn't moved all that much. The price of oil is kind of danced right around the 70 level. We're a little below that right now, where we're seeing a little bit of exiting from oil positions. Then we look at the LEI, which I talked more about in length yesterday. When we drop below this -4 level, this is really suggesting that we could go into a recession. And this is one of the pieces of evidence that we use to say, yes, we are going to go into a recession. There's other evidence that we look at that says, no, we're not necessarily headed into a recession based on what we see right now. Then after July, the year-over-year comps for inflation get tougher. This is when we get the next CPI report, and based on what it comes out at on a month-over-month basis, then how that equates into an annual inflation rate. Then looking at the Fed credibility, and they've really had some issues with that. It's on the ropes again. This is that they're expecting rates to actually come down. The red line are forecasts going forward. Edward Yardeni had an interesting chart where we're looking at the LEI, and that's what came out yesterday, and that's the red line, and it is declining. But when you look at a thing called the coincident economic indicators, and this takes some other things, puts them together, and tries to measure where are we at right now, that's the blue line. This is actually going up. So this is showing some strength where looking forward, it looks like we're seeing some weakness. And then most of the indicators that we look at actually look backwards and tell us what's already happened. Looking at our analysis, we did gap lower down below S1, didn't quite make it down to S2, tried to bounce up a little bit, came back down. Then we saw some strength coming into the market where we actually were able to get back above S1, but that fizzled out. We dropped back below S1, came all the way down to S2, but we did close a bit off of the low. Here's the intraday chart where we were looking a lot more positive in the initial overnight session. Then, as Europe opened and things were turning a little bit more negative, we saw the SPY really drop off. That led to the negative open. We spent some time trying to come back, but then we ended up seeing weakness later in the day, and then we've trailed off as the market closes for the weekend. On the positive side, large cap growth did outperform large cap value. Value was down on the day where growth was pretty much unchanged, so on a relative basis, it outperformed. So when we look at the closing values though, growth was down more. Mid caps were down about the same to a little bit less, and small caps again about the same but a little bit less. The growth to value ratio, it was showing a lot of improvement during the day. We actually got to a point where growth was positive compared to value, but then we saw some weakness going into the close. Looking at sentiment, the Ulster Index is turning up just a little bit as we're seeing a bit of a pullback right now. And the VIX did turn up slightly with the line chart as well as the bar chart. Here's the VIX of the VIX, which turned up just a little bit, but is right about at the moving average. And then the VIX to VVIX ratio is very low right now, again suggesting that there's not a lot of fear in the market. We're seeing the overall ratio declining, and then we're seeing the moving average also continue to decline. The equity put call ratio, and this is kind of interesting, it actually fell. Even though we're not really working off of a signal right now, we're not seeing a lot of hedging going on at this particular time. That could be taken as somewhat positive. Then longer term, we're also looking more positive. With our 253-day simple moving average, it does look like it's continuing to roll over and go down. The longer the VIX stays low, that feeds over into the equity put call ratio, and the more positive this chart can become. We also had the active asset managers recent survey. Remember, this is a week or sometimes 2 weeks old, where they're at a pretty high level right now. These are the folks that were probably under a lot of pressure over the last few weeks when we were going up pretty strong in the market. and they're like, nah, there's really not much behind this move that's going up. And then all of a sudden we started breaking out and they had to jump in and do something, and that gave kind of a high reading. We're not extreme positive, but we are in that area where maybe they are a little extended to the upside. Then another sentiment gauge. This looks at fear and frenzy. This is just about where we're at right now with the other sentiment gauge that we look at. We had the most recent reading from the American Association of Individual Investors. They had been a little more positive in the last reading, and they dropped down slightly in the latest reading. We turned down just a little bit with our fear gauge, and we're also declining overall. So this is suggesting that fear is not all that prevalent. We turned up a little bit with our other fear gauge, but we have been declining overall. We saw a tick down with our risk-on, risk-off analysis, but we're still seeing a favor towards a risk-on posture. Advanced decline line, we're seeing some weakness here. We decline based on price and volume. A lot of the improvement that we had been seeing is starting to go away. New highs, new lows. We're still seeing the new highs hanging in there all right. Not much of an expansion of the new lows, but we're starting to roll over with our 5 period, and we're going down slightly with our 10 period. Accumulation distribution did show some weakness, but we're still above the moving average. The advanced decline ratio, the shorter term one, which is the blue line, has now dropped below 0. And this is another area that was looking more improved, but now it's starting to show some weakness. The cumulative advanced decline line for the NYSE really showed some weakness, and the regular advanced decline line has now dropped below the moving average. We're also seeing this other advanced decline line dropping below this upward sloping trend line. We were seeing a little bit of improvement based on common stock, looking at price and volume, but now we're starting to show some more weakness. When we look at our broader market, look at the advanced decline line study, the NYSE is now dropping below the moving average, the S&P is down back to the moving average, and we're seeing more weakness with the mid caps and the small caps. Looking at our trend, where the green line is on top, and it's really coming down, the ADX is still above the moving average, but it's starting to roll over. Our shorter term basis, we actually crossed below the moving average here as the green line has been coming down. Volume really picked up, but again, that was due to more of an adjustment of the indexes. On the short term basis, we're still above the August 2022 highs. Will that offer some kind of support? If we fall through that, then we might see selling really accelerate. I also tried to extend this trend line. If you know much about me and trend lines, whenever I see a chart that somebody has all these different lines, with ultimately an arrow going down or up, I pretty much just throw that out the window. If you draw enough lines on a chart, you can get it to say pretty much anything you want. Well, I did take some liberty and extend this trend line to note all the way up to here because that may have been providing some overhead resistance. And then on the bottom, you can see where volume went well above average. The 20-period exponential moving average is now declining and dropping below 50. We're seeing weakness in the 50-period as well as in the 200-period. And then when we look at the 20-period double and triple exponential moving averages, we're now starting to drop below them, which is turning more negative. But when we look at a regular 20-period moving average, both the simple and exponential, we're still above both of those. We could come down to this level and see if that provides support. Here's the Stochk RSI, which is already extreme negative, and we're coming down below the 10-period moving average in the rainbow. Could we continue to go down to the 20-period? Here's the stochastic study where we're no longer extreme in the short term, intermediate term. We're still extreme in the long term, but we are coming down. The force index is now dropped below 0. Intermediate term charts, we're still hanging in there okay with the balance of power. We're above the midpoint, but we're showing some weakness. And then looking at our 50-period double and triple exponential moving averages, we're below the red line, but still above the blue line. We're still far away from the regular 50-period moving average, so I didn't include that chart. The go, no-go system remains more neutral with lighter colored blue bars. The TTM squeeze, after giving us an extreme positive reading, is now starting to decline. And here's a longer-term look at that same chart. We're coming back down now into the first standard deviation on this chart. This dashed line is the midpoint. As long as we stay above that, we still have more of a positive bias. We're wondering if some kind of support will happen in here and then see prices go up, or are we going to continue to fall? The PPO study is still positive in the long and intermediate term. We're still positive in the short term, but it is declining. Our McClellan oscillator based on the S&P 500 has now dropped below zero, so that's turning more negative, as well as the NYSE McClellan oscillator. So when we look at our summation index based on price, it's now turning down, and volume turned down before this a couple of days ago. Our Rune indicator was unchanged, but after giving us an extreme positive reading is now coming back down. The summation index based on price and volume for the NYSE did roll over slightly. Some of the improvement that we've been seeing may be in jeopardy. The Swenlin trading oscillator based on price and volume has now dropped below zero, so that's turning more negative. The PMO, after getting to kind of an extreme positive reading, is still positive overall, but is starting to roll over. We're not quite crossing negative yet based on price, and we're just crossing negative now based on volume. And our PMOs that are rising continue to decline. We're no longer extreme with the buy signals, and we're pretty much flat with the PMOs that are above zero. The Elder Impulse system for the S&P remains at neutral, and the parabolic SAR system is still negative with the dots on top. The slope is rolling over and is now turning more negative, and we're seeing just about a crossover with the MACD. So when we look at all of our oscillators, short term, we're looking more negative. Intermediate term, we're rolling over. We're still hanging in there in the long term, but we're getting some extreme readings with the tricks and the KST. The Sean trend meter is no longer extreme positive. The BPI is holding up okay. It declined, but it's not really going down like you might expect. So far, this seems to be suggesting that internal strength is holding. Now, that could always change. We can only go with what we see right now. The NYSE bullish percent index is rolling over, but is still above 50. The Chaikin money flow is still looking positive, but the Chaikin oscillator is declining. However, it's still above zero. The money flow index is turning down, but still above 50. The ultimate oscillator also turning down, but above 50. The vortex, the green line, is on top, but it is declining. On balance volume also declining, but still above the moving average. We're seeing a little bit more weakness when we look at the 200-day simple moving average of the stocks inside the S&P. It's coming down based on this study. It's also dropping back down based on the 50-period study. And here's another look at that same chart, if that gives you any additional insight. The Copic curve signal is now going away. It's crossing below the red line. However, the Pring bottom fisher buy signal is still in force. Looking at our Fibonacci and line studies, not really much was decided yet. We did hit some resistance and we're coming back down. We're also wondering, are we going to come back down to this 100% retracement level, which is the August 2022 highs? Will that provide some kind of support? Longer term, we're also coming down to the 61.8% retracement level at 43.13. If we really start to fall, we're coming down to another fib level at 42.14. Our different charts, we're still looking more negative with the Heikin Ashi with dark candles. The Kegi chart is still positive but pointing down. There has been no redrawing of the Renko chart, and the 3-line break is still looking positive. The equal weight index did move down, and it's also continuing to underperform the S&P 500. The equal weight index, where we see on this next chart, the ratio between the two shows that the bigger stocks are holding up better than the smaller stocks. Looking at Dow theory, we're seeing a little bit of weakness in the transports after we had been seeing some improvement, but still this is holding up fairly well. We're seeing more weakness now in the utilities on a shorter term basis. The transports continue to show a little bit of improvement, but are underperforming the Dow. The equal weight discretionary and staples study, we turned down a little bit with discretionary. We also went down based on staples, and our ratio was pretty much flat, but discretionary is still in an upward trend when compared to staples. Think of it another way, growth versus value. The Dow did break below support at this R1 level, but we remain above the 50-period moving average. The diamonds, though, have switched to negative. The NASDAQ is still above this R1 support level. But when we look inside the NASDAQ and look at the cumulative new highs minus the new lows, they're flattening out a little bit, and the indicator itself is continuing to be below zero. We're also coming back down after hitting the 61.8% retracement level. Is that providing overhead resistance? And we also have a previous high in the NASDAQ 100. We came right about up to that high. We've been bouncing down, and we're currently right at this R1 level. However, the Qs for the Elder Impulse system remain neutral. We're turning more negative, though, with the NASDAQ 100 BPI after giving us an extreme positive reading has been declining. We're still above the 61.8% retracement level with the NASDAQ 100, and that's still a ways below current price. But on a ratio basis, the Qs continue to outperform the Dow. The small cap index, which is working off of a recent death cross, did see some more weakness, although we came down to this R1 level. That's positive, which is acting as support, but on a negative basis, we have now dropped below the 200-day moving average. And then looking at the Russell 2000 small cap index, the RSI has now dropped below 50, and the MACD has now turned negative. And for the Elder Impulse system, the small caps remain negative. And small caps continue to underperform the S&P 500. But when you look inside the small cap index, we're still seeing growth hanging in there fairly well. With the mid caps not really hitting any support level now. We saw a recent golden cross, but there has been some weakness in this index. We've switched over to negative for the Elder Impulse system. But when you look internally, growth is still outperforming value. The dollar was up a little bit in Friday's session after having a series of down sessions. And then the home construction. This continues to hold up quite well. It was up on the day. And as I say, if the economy was really getting ready to head into some difficult times, and if interest rates were getting ready to really go up, this area of the economy, home construction, is heavily influenced by interest rates. Why would this ratio be going up? Especially when you compare it to the 3 to 7 year Treasury bond ETF. Growth is still holding up okay when compared to value based on this chart. Keeping an eye on the financial sector, down almost 0.5%, and we continue to be in a downtrend. And the financials ticked up just a little bit compared to the S&P, but are still in an overall downtrend. The regional banking ETF is back to really underperforming the financial sector. Bonds, we saw yields going down slightly, where we saw price going up. And this is another concern where we're seeing this ratio continue to go up. If the market was more certain about what was happening with interest rates, this ratio would be going down. In fact, now it's starting to go back up. And we're still keeping an eye on this. We're above the 3-month yield, which we set back in 2007. Is this giving some kind of a warning sign? Our long-term analysis, we're looking more positive with the special K based on the daily chart, but we're looking more negative based on the weekly chart. An update of our possible positive scenarios, we have dropped below 0 based on price and volume with our 19-day exponential moving average of the advanced decline ratio. The Qs, though, still continue to outperform the S&P. Discretionary is outperforming the S&P. Large cap growth continues to outperform large cap value. With the large caps, we're seeing a bit of an improvement also with the mid caps, and we saw a bit of improvement also with the small caps. The S&P to utilities ratio is still going higher overall. That could give some support to the S&P. When we measure things on a broad basis and take a 5-period moving average of the highs minus the lows, we're declining, but we're still above 0. And we're also still above 90 when we look at the 10-day average of the S&P 500 highs minus the lows. When we look at growth versus value for the S&P, it is showing a little bit more weakness, even though it's still in an uptrend. But lately, we've been chopping more or less sideways with a downward bias. The 50-period exponential moving average of the new highs minus the lows starting to roll over just a little bit, but our indicator itself remains above 0. And when we look at staples to the S&P 500, we did tick up slightly in this ratio, but it continues to decline overall. So what's our outlook for Monday? The technicals are positive, but we're turning more negative. We're going to need to see some buying coming into the market to try to turn things back more positive. If we see more selling, it's just going to turn things back more negative. We don't have any economic reports coming out on Monday. We have the whole list of geopolitical events, with inflation and interest rates being the real focus, which are producing growth concerns on a global basis. Here is the calendar for the week of all the economic reports that will be coming out. Probably the most important one will be the PCE prices, as well as personal income and spending that will be coming out on Friday. We'll get another estimate for GDP in the upcoming week, and we'll also get some more housing data. Here's a schedule of different speeches that will be happening in the next week. They're both from Jerome Powell. He will be going to Portugal on Wednesday, and then on Thursday he's going to Spain to meet with Pablo and talk about financial stability. Looking at the Stock Traders Almanac statistics, it's pretty negative for Monday, June 26th. We're negative across the board. We will be on the 17th trading day of the month, so we still have another couple days of historical weakness when we look at the green dash line. Also, when we look at the green line itself, they are both going down. Once we get into the 19th or 20th trading day of the month, that's when things historically have looked a little bit better. But when you look at the NASDAQ, we still are in this positive seasonality that goes up until the middle part of July. So our scenarios, really hard to go with the down one because we're still looking more positive overall, although we are turning more negative. Hard to go with the up one because we are seeing some weakness right now. We're still trending overall, so it's hard to go with the sideways trend as well. So our warning signs, the parabolic SAR is negative, the BPIs are diverging. So far, the BPI for the S&P 500, even though it's declining, is still holding up fairly well. The VIX is showing that there's not a lot of fear. The Copic curve buy signal has now ended. The cumulative new highs and new lows on the NASDAQ continue to show weakness. We're still above that longer-term 3-month yield when we go back and look at what happened in 2007. Earnings season can either be positive or negative. On the positive side, we do have these seasonality and setups that are in the background that remain positive. The long-term special K indicator on the daily chart has switched positive, where on the weekly chart it is negative. And the long-term equity put-call ratio with that longer-term 253 period moving average, it's still looking like it's turning more positive. The Pring bottom fisher is still generating a buy signal. The S&P is still above that downtrend channel upper line. If we see more weakness, I will be bringing that chart back. We're still in a basic risk-on posture, even though that ratio has been declining. Lower price levels may provide support. We may go down and test the August 2022 highs, and then we'll see how the market acts if that happens. The S&P continues to outperform utilities. The NASDAQ and NASDAQ 100, they're continuing to break out, but they have this pretty significant overhead resistance, especially in the NASDAQ 100. The Staples to S&P 500 ratio continues to decline, even though we saw that tick up slightly in Friday's session. The mid-caps have generated a recent golden cross. Small and mid-cap growth continues to be positive overall. So our conclusion, the S&P is positive, but it's in the process of turning negative. Now, we could switch back to positive, but we need to see some buying coming in. Short term, we're turning more negative. That's where we look more negative right now. We're turning more negative in the intermediate term, but we still remain positive. We're still positive in the long term. Thank you. I hope you have a wonderful weekend, and I will talk to you in the next video.